Welcome to the Aussie Firebug podcast, the financial independence podcast for Australians. Hi guys, welcome to another episode of the Aussie Firebug podcast, the financial independence podcast for Australians, where I interview clever people who have already reached or are on their way to financial independence. I'm really excited to introduce our guest today. Chris Brycki holds a Bachelor of Commerce from the University of New South Wales, was the national winner of the ASX Schools Share Games 3 years in a row from 1999 to 2001, 3 times national winner of the JP Morgan's University Portfolio Competition, a highly experienced trader, spending most of his career as a portfolio manager at UBS, investing the bank's capital. So this is serious stuff here, guys. But most importantly, and the reason he's our guest on today's show is because Chris is the founder and CEO of a relatively new robo-investing company, Stockspot. Chris, welcome to the show.
Great to be on the show.
That's quite an impressive resume you have there. And I got to ask, with the ASX School Shares Games that you won 3 years in a row, I think they ran one of those. They do it annually, I believe, but I think I entered it 1 year. Is it basically that you just pick stocks for like 6 months and the best return wins? Is that how it works?
Yeah, it's similar to that. So some of your listeners probably would have played it when they were at school. I think they've actually been running it since the 1970s is what I understand. Mm-hmm. But back in the 70s and 80s, it used to be a paper-based thing. So you'd actually have to submit your stocks by paper. I think later on it became fax. And when I started entering it was in the late 90s or early 2000s, or late 90s actually. And it was one of the first years that it became an internet-based thing, which was pretty exciting. So it was a live trading game. I think it was for 6 or 8 weeks. And they allowed you to trade the top 100 or 200 stocks and gave you like a $50,000 nominal portfolio to trade. And then, you could basically trade as much as you like. That they made it as realistic as possible. So they charged you brokerage and commissions. Mm-hmm. I remember at school I would go basically to the library whenever I had spare time at lunch times and after school do research and spend a lot of my spare time doing it because back then the prize money, which I think was $1,000, was huge money for someone in year 7. So, big incentive to put all your spare time into that rather than getting a job at Woolworths.
Yeah, definitely. It's quite impressive actually because it sounds like the game that I played on the same site. I think I signed up for it last year or something, but it was, it is very hard to pick stocks and come out ahead. So for you to do that 3 years in a row, it's actually really impressive. Did you win by much or was there a top 10 or something or?
I think it actually varied quite a bit year to year. So I think I first entered in year 7 and I think that year I think I might have got into the top 20 or something and it was just kind of learning. But then I kind of worked out with a short-term game like that, the strategy you have to take is very different to what is like a sensible strategy over the long term or medium term. You really just have to take a very high-risk strategy and focus on those stocks that are most volatile. So I think a lot of students actually built very sensible portfolios, bought a few bank Belstrat. Whereas I think the first year that I won it was actually, or one of the years I won it, it was when the Twin Towers came down, sadly. But one of the shares that was very volatile in Australia around that period was QBE Insurance because they actually insured the Twin Towers.
Oh, wow.
And I think the share price of QBE crashed something like 80%, and it was sort of that volatility that created for better or for worse trading opportunities. Yeah. And so in short-term trading games like that, or just trading in general, like volatility is your friend, but obviously long-term, if you're an investor, it's actually the opposite.
Impressive, nevertheless. Now, before we get to Stockspot, I just want to dive a bit deeper into your backstory and how you got to where you are today. As we've already talked about, your resume is really impressive. Growing up, were you always interested in finance?
I think from probably around the age of 12 or so, I became interested. So the story behind that was when I was, I think it was 11 or 12, my dad, who really has nothing to do with finance, he sat me down because he thought it was an interesting thing to to teach me and my brother and said, look, this is how the stock market works, Chris. Like when companies want to raise capital, they basically go out and ask investors for money, and then after they've raised that money, there's a secondary market basically where people can buy and sell, a piece of that business. And so I always thought it was quite an amazing concept that you could actually own parts of, businesses that you'd actually have dealings with day to day, whether it was, Woolworths, or back then Billabong was a good share, or, shares that, you would kind of buy their merchandise or use their services, and you could actually own part of the business. So back then Dad actually said to me and my brother, here's $1,000, go and screen the newspaper and find a stock to invest in, or do some research, and whichever one you pick, I'll invest on your behalf, and then you can watch it. And then, decide when you want to buy it or sell it or change your investment. So that's how it started. And I think with that first $1,000, and I actually kept a diary, which I still have. I think that was back in the late 90s. So this will date me, but I think it was around 97 or so. And I chose Ashton Diamonds back then, which isn't listed anymore, but it was one of Australia's larger diamond, explorers and producers. And I bought it, I think it was 50 or 52 cents, if I remember correctly. And about 6 months later, I was tracking it, on a day-to-day basis, and getting very excited because there was, it kind of ground up from about 50 cents to I think $2, and then it got taken over by De Beers Diamonds at $2. So I was very, very excited, as you would be as a 12-year-old that thinks that they've sort of made a few $1,000s. But then when I went to cash in and told Dad, I wanted to sell my Ashton Diamonds investment, he broke the news to me that actually it was just a hypothetical thing and he didn't actually buy the shares for me in the first place.
Oh, you're kidding me.
I was just so furious. I was like, I'm definitely going to learn this stock market thing and do it myself because I don't trust Dad.
Well, I suppose he was, he was trying to do the right thing, right? That, he didn't want you to waste your money, but that's quite funny. Yeah.
Well, yeah, he didn't. I think he thought I'd pick some garbage that would go to zero, and then it would actually be a nice thing to tell me I didn't actually lose his money. But it worked out the opposite, where I was furious, and then I basically said, okay, that's it. Like, I'm going to earn pocket money, and then I'm going to invest it myself, and I'm going to be sure that I actually do have my investments, because, Dad's basically tricked me here.
That's a funny story. So your dad taught you about the how the stock market works, and you were really interested in that you could own a business that you deal with day to day. This was what, you were 12 or 13 years old. So were you just really fascinated with trading and finance in general, or was there another motive for earning that money, or was it mainly just you were interested in how it all worked?
No, I think as a kid, it was like any other hobby. So, some people like computer games, some people, like different sports. I also, played a lot of sport, but whenever I had spare time at home, between doing homework or, on the weekends, I just loved researching companies and trying to understand. I mean, really, for me, the stock market's it's a bit of a game, but also just a great challenge to kind of try and understand how companies are valued and how people kind of determine the price of a share. And I think it's a great sort of combination of, somewhere where kind of a science meets a bit of an art, because there's actually no kind of perfect way of doing it. And so it was, I think, an area that I just was very fascinated in learning, how to kind of beat this game and understand it, to the point that, you can, grow your wealth and then earn money from it. But also, it was a challenge where when you make a good trade or make a good investment, you kind of get this sort of feeling that it's very difficult to describe, but it's kind of a feeling of sort of satisfaction that you've kind of solved a riddle almost. Yeah,
great. So you take that enthusiasm and the passion to learn into high school, and I've already touched a bit on your qualifications. I did some LinkedIn stalking there, but when did you know that that's what you wanted to do as a career?
I think probably quite early on. So like you mentioned, I used to always enter those ASX games at school, and then at university there was a similar game that JP Morgan sponsored, which I'd always enter. And I think that was a great training ground to kind of learn how markets work, and it was a cheap way of getting experience, because I think in any sort of, or especially when investing, losing money or not going well is the best way of actually learning. And so it helps when that money is hypothetical. You probably learn more when it's your own money, but being able to like practice in those sort of competitions was, a great way of just honing in on your skills. Probably like anything else, you need to put those 10,000 hours into actually learning. So I probably got, a section of those 10,000 hours done while I was at high school and more while I was at uni. And then I was fortunate at uni when I won that JP Morgan game one year that the company that sponsored it as well as JP Morgan was a little hedge fund that ran out of Sydney. And a hedge fund is, basically basically a bunch of former futures traders that had set up this business to basically trade ASX listed stocks and commodities and currencies together. And they'd seen how it performed in the game, and they thought it would be, I think, it was partly philanthropic, but they offered me to come in and do a bit of work with them and learn about trading. And then eventually from there, they gave me like a small book to actually trade. So they gave me some money to trade, which was pretty exciting I was still at university at the time. And then it all kind of went from there. Yeah,
great. And so you progressed through your career. Now, what was the moment that caused you to break the 9 to 5 day grind and start your own business? What was the what was the cause behind that?
Well, so following on then from that first job, I was again fortunate. I had applied for a lot of the graduate jobs that the investment banks offer in Australia, and I think mainly because we're at the top of the boom. So this was in 2006, 2007. All the banks were hiring a lot of people. And I managed to get a job on the UBS trading desk, which was probably quite uncommon for like a graduate because it was a big responsibility job. And
highly competitive market, isn't it?
Yeah, very competitive, and typically something you need a lot of experience to get onto. But I started as a junior on the desk where I was supporting a few of the other traders, and then eventually grew my book to be trading a decent amount of capital. But in working on that institutional side of the world, you kind of learn a lot that you don't see on the retail side of the world when you're just trading for yourself or a mum and dad type investor. And a lot of the things I saw working on that side kind of opened my eyes to how the industry actually works. And a lot of those kind of quirks of the industry I thought were very unfair for retail investors and actually put people at a huge disadvantage to the industry.
What were some of the things that you were seeing?
Well, one of the things that really irked me with the industry and still does is that in Australia, there's this huge equity mentality. People love owning shares in Australia, which is a great thing. But I think, historically, I know my parents' generation, a lot of the older generation have spent a lot of time trying to pick stocks because they think that's the way to grow their money. And certainly I believe there's a few people, there are people out there that are able to pick stocks and do quite well, but it's very, very difficult. And unless you're doing it full time, like I was doing at the hedge fund at UBS, then you're very unlikely to succeed over the long term just because there are so many people doing it full time these days. So it's such a competitive industry, that as a retail investor to beat the market, it's very difficult, as it is.
And also you got those people that are doing it full time, like you say, that still don't beat the market.
Yeah, and that's what's become more and more evident over the last 20 years in developed markets like Australia and Europe and the US is that even professionals now, on average, underperform the market because it's so competitive. So something that irked me is that the whole industry loves to tell investors, and whether it's retail investors or anyone else, that the more active you are in shares or the more you do, the better chance you have of making profit. So there's a lot of trading programs out there that try and convince people to pay for subscriptions or to trading newsletters or, financial advisors. But the whole industry is geared to making people think they need to do more, when in reality, to actually succeed in the stock market, it's actually about doing less, just having the right sensible long-term strategy and then not doing anything. And I think it's a bit counterintuitive because in a lot of other areas of life, for instance, fitness is a good example. You know that if you're lazy and you do nothing, it's actually bad. So you actually need to be active to succeed. Whereas in investing, a lot of people are tempted to be trading a lot or making a lot of decisions, but that actually harms them, mainly because of the costs and because of the behavioural biases that people have. So I always don't like that the financial industry basically takes advantage of the fact that people aren't that literate when it comes to investing and think that they need to do a lot, which is great for the financial industry because the industry makes a lot of money off that through commissions, through advice. But the reality is that people really shouldn't be paying a lot of those costs because they're just not necessary.
It's a great analogy you use with fitness because I even, myself, I invest in real estate, but I'm leaning towards, I'm going to buy a few ETFs this month. And going forward, the more and more that I educate myself, the more and more this passive styling of investing makes sense to me. But it is very, it seems backwards, like you said, because you think when I first started, I had to read, I must have read when I first found out about financial independence and it was a real thing and you could, retire early and all that. I must have consumed about 20 books within the first month and a half. I read everything that I could get my hands on. And I felt like if I wasn't doing something, I was letting it slip away. So I was trying to be active and I was trying to, research everything I can. But it's a good analogy that you use with fitness. It's like that, if you're not doing something,
you feel like you're behind. And I think that's the issue. A lot of younger people actually avoid investing in shares because they think, well, because I don't have time to do all the research, I'm going to lose. I'm not going to succeed, so I might as well not do it at all, which is really sad because the reality is that those sorts of people have probably an even better chance of succeeding than the people that are reading the news every day because the people that are just in there for the long term avoid all of that short term noise that causes those people that are reading the newspaper every day to make the wrong decisions.
Yeah, great. So you start your career. It's really impressive, and you're dealing with your investing capital, the bank's capital, I believe, and you're going through your career. You start to see these things that are happening that don't sit well with you. How long until you decide that you're going to break away from the industry and start something else? Because it's quite a leap of what you're doing with Stockspot. Did you see another product maybe overseas that was doing it better that you said there's nothing like this in Australia and you can start one here, or how did that come about?
Well, bigger picture. So I used to trade the retail sector. That was one of the sectors I used to trade at UBS, and I saw in the few years that I was trading that sector immense changes in how the different companies were operating and the new competition that was coming into the industry. A lot of online retail was starting to emerge, and so it was very interesting to see how that sort of developed and consumers over time became more accepting of online retail. And there were a lot of skeptics at the start saying, oh, no one will ever buy shoes online, like you have to try them on. But what I saw is a lot of big businesses like DJs and Myer sticking their heads in the sand saying, oh, this thing's never going to take off, while businesses like Kogan were having huge success acquiring a lot of especially younger customers who were prepared to purchase retail items online if the price was right and the quality was right and they had trust in those companies. So I translated that to the financial industry and thought, well, this industry that I work in, the reality is that, it's still kind of like the traditional retail industry, where, the old school sort of DJs where you go in and someone helps you try on the pair of shoes and it's, historically great service, although I think the service has probably been deteriorating in those retail stores. But basically people come to expect a high level of service, but it's face-to-face service, which is very expensive. And as a result, in Australia, if you go to DJs, you pay probably 40% more for shoes than you would if you bought them online through Amazon. And I think the same I was seeing in financial services. People spend a lot of money basically for face-to-face type advice and like high-cost advice. But the reality is that they could get better outcomes by doing the same sorts of things online and cutting out a lot of these people who can add a nice sort of service touch, but in reality, not everyone wants that.
Yeah, fantastic. All right, let's get into Stockspot, the company that you're the CEO of and the founder. So for those that don't know, why don't you just tell people a little bit about Stockspot and what you guys do?
Sure, yeah. So Stockspot was a business I started about 3 years ago now. It was a business I thought of while I was working in the investment industry and spent a lot of time thinking of how it would work. But the idea is that we aim to make it very easy just for anyone in Australia to invest in a diversified portfolio that's tailored to their own personal situation. And the whole process is online, which makes it as convenient as possible for people. And so they don't need to worry about all of the hassles of investing that they'd have to do if they manage their own portfolio. The business, originally I set it up and it had a founder, and we've grown it now to 8 people over the last 3 years. It's a very technology-focused business because something I saw that was missing in the traditional industry was that the typical experience of getting wealth management advice was really lacking a really nice user interface and a really nice experience for users. So we're very tech-focused. We try and make the experience quite seamless for people because a lot of our customers are professionals who don't have time to manage their own investments. And the aim is to really just give people the right advice about what they should be investing in and avoid a lot of the conflicts of interest in the industry that cause people to do the wrong thing and invest in high cost funds or trade too often.
Great. Now, I've actually had to go myself and I went through like the Robo Wizard and stuff like that. But for people listening, so your company is basically offering, in a nutshell, if you have some money that you want to invest. Now, I think there is a minimum that you guys take. Is that right? Is there a minimum amount that you can invest with Stockspot with?
Yeah, that's right. So our minimum investment that you can invest with us is $2,000, which we decided to make it as low as possible because there's something, again, I saw with the industry is usually to see some sort of broker or financial advisor, you need a lot of money to kind of make sense for them. So most advisors actually turn you away if you don't have, let's say, $100,000 or some even higher. So I basically saw a big opportunity where there are a lot of my friends, like younger people who might have saved up, $2,000, $5,000, $50,000 and don't know what to do with it and are deciding between, maybe saving up to buy a property in a few years' time, but they actually want to be able to keep up with the rising property values so they can afford it when they get to that point. And obviously with interest rates falling, it makes it very difficult to keep up.
Yeah, good point. So it's basically, minimum of $2,000. So I went through the wizard and for people listening, it's basically like you have some money that you want to invest in, you go into the site, you sign up, the robo investor advice will run you through like a wizard, and it will get your risk tolerance, how long you want to invest for, and a whole bunch of other things, and it puts you into a certain asset class or one of the portfolios. I think there's you got like 4, is that right, or 4 or 5?
Yeah, so the process is similar to that. So basically people come to our website, answer a few questions about their personal circumstances, and that's things around, when they're going to need the cash, how long they're looking to invest for, what their acceptance of risk is, so how they're likely to act if there's volatility in the market.
So typical things that you would find if you went to someone that was going to manage your wealth, like face to face.
Yeah, exactly. And I think something that, like I saw in the industry, is the industry really overcomplicates that side of things. But the reality is that if you have a reasonable time horizon and, don't need cash in the next couple of years, then the best strategy for someone with $2,000 is actually very similar to the best strategy for someone with $2 million. And that is just to buy a very broad, diversified mix of different assets, including shares and bonds. And make sure that, and what we do is make sure those assets are combined in a way that helps to reduce risk. So you're not exposed to like individual companies.
Yeah. Now let's get into that a little bit. What exactly does Stockspot invest in? When we hand over the money, what are you guys doing with it?
So what we do is we invest in a broad mix of different ETFs or exchange traded funds. And what these
are... For people that don't know, you're about to go into it. For people that don't know what those are exactly, do you just want to touch on that?
Yeah, sure. So exchange traded funds were a type of product that first emerged probably 20 or 30 years ago, but really have only just started to, be used in Australia over probably the last five years, realistically. But they're basically a financial product that you invest in through the stock exchange, that trade throughout the day just like any other share, but instead of buying a share, you're basically buying a listed managed fund that owns lots of different shares. or any other asset class. So you can buy an ETF that tracks Australian shares. You could buy an ETF that tracks American shares. You could buy an ETF that tracks metal like copper or gold, or you could buy an ETF that tracks a different asset like bonds. And so the basic principle of ETFs is they are like managed funds, but where managed funds are unlisted, ETFs are listed, and then they trade on stock markets and track a certain asset class.
So you're basically buying a slice of, if an ETF tracks the index for an entire country like Australia, you're basically buying the Australian economy. Is that what you're doing?
Yeah, you're buying the Australian stock market essentially. So you're buying a piece of, we buy in our portfolios a part of the ASX 300, which is the 300 biggest companies in Australia, and you buy a piece of all of them. But instead of having to buy all of the companies individually, so go and buy some Commonwealth Bank shares and BHP and, all the way down to 299, 300, you just do one trade, and with that one trade, you get exposure to all of them.
Yeah, and you mix. So that's really powerful, and I've read the research behind this as well, and the general idea is it's really risky if you're buying one company. Companies have gone bankrupt before. It's not out of the ordinary for a big company to go bankrupt, but it's pretty unlikely if you have ETFs in multiple countries that are covering multiple markets and precious metals and whatnot, that for all of those to collapse at the same time, the world would pretty much have to be exploding or something like that. So my understanding is... Sorry, you continue. You're the expert. I'll let you explain it better than I can.
Yeah, I think you've described it very well. So the benefit of, and you're basically describing the benefit of diversification, which is something you learn in finance, but, the industry overcomplicates it for the average person. But, in a sentence, diversification means that you don't need to take any risk on any one particular company, and you shouldn't want to. So when you invest in shares or in the stock market, there's two types of risk. There's what's called systematic risk and non-systematic risk. And systematic risk is just the risk of the stock market. So the stock market goes up and down, and that's a risk that when you buy shares, you can never really get rid of. You get compensated with a higher return for taking that risk, but that's just the risk of investing in shares. But the type of risk that you should be able to get rid of is, as you described, like the individual company risk. So the risk that, a company in your portfolio might go bankrupt or have a profit warning. If you've only invested in 2 or 3 shares, that's going to have a really big impact on your returns. Whereas if you've invested in hundreds or thousands of different companies, if Apple has a profit downgrade, for instance, if Apple's only 1% of your portfolio, then it's really not going to have enough impact to make a huge difference. So I think the problem a lot of people have faced in Australia, and it was particularly apparent in the financial crisis, was Australians typically have very concentrated portfolios in a few shares. So, I know, my parents' generation, typically they would have a few bank shares, maybe some Telstra, Woolworths, Wesfarmers, and maybe some BHP. But the problem with that sort of strategy is it's not really diversified very well. And so, if there's a problem with the banking sector, for instance, or, like material prices fall, then it has actually a very big impact on your portfolio. And that's risk people shouldn't take and shouldn't need to take. So our aim is to help people reduce that type of risk, so you get exposure to the market without the risk of individual shares.
Yeah, fantastic. And the different portfolios, as I understand it, match your risk tolerance, but as well as your time frame. So if you tell the robo investor when you're signing up for Stockspot, I don't care if I can't withdraw my money in 10 plus years, that's fine. Then Stockspot might allocate you to a portfolio that's a little bit more risky, but with a return that might be a bit better than something that's more conservative. Is that right?
Yeah, that's about right. So what we try and do is match people based on their answers to what we think is their optimal portfolio. And to work out the optimal portfolio, there's lots of different factors, but one, like you explained, is your investment horizon. And the general principle is the longer your investment horizon, the more exposure you can have to growth assets like shares, because short-term volatility won't impact your long-term outcome as much. Whereas if you're only planning to invest for 2 or 3 years, that short-term noise or volatility in the market can have more impact because you don't know if, there might be a recession next year that causes your shares to fall. But then if you need the money out next year, you've got a bigger chance of suffering a loss. So generally when you're investing, your ability to take risk, and it's not necessarily risk tolerance, I actually probably prefer to call it risk capacity. So it's your ability to take risk is actually mainly dictated by a couple of things, but one is your investment horizon. And then, two is also your cash flow needs over that period as well. So if you need cash in 1 year to buy a property, then you probably shouldn't be buying shares at all because over a year, there's probably only let's say a 60% chance that shares are going to go up. So you're more or less flipping a coin if you're investing over a short period of time.
Yeah. Quick side note, because you were in the thick of it when the financial crisis hit. What was that like working at the bank when 2008 rolled around?
Well, I think it's a pretty phenomenal time to start a career when the world's basically exploding in your industry.
No.
So, and coincidentally, a lot of the people that were on my team then, they started their careers in 1987. So they could share a few stories with me. But yeah, I mean, it was a huge change in terms of how the whole industry operated, and I don't think it's really fully recovered. I mean, as a graduate, it was exciting but very frightening because, I just started my career and within a few weeks they basically told me that they were halving the size of my team from 14 to 7 people and that I was a 50-50 chance of being made redundant. Wow. Even basically at the start of, my career. Fortunately, I think I was the lowest paid in that team, and so that was a good reason to keep me to do all the grunt work. So I think I was saved by that. But, I think it taught me a lot about risk and understanding risk, but, also understanding that you don't always understand all of the types of risk. So it's about accepting that you don't understand risk in many cases and trying to protect against different types of scenarios that even the best experts in the world can't predict.
Okay. Now moving back to, Stockspot, how much does Stockspot charge for the service?
So we charge, essentially 2 fees. And one is like an advice fee, which we limit to people that invest more than $50,000 a year. And that's $50 plus GST per year, and that fee basically covers the cost of us providing financial advice to the people. So one of the differences between our product and just buying stocks on an online broker is that we actually are providing what is considered personal financial advice to clients. So we have an obligation to always make sure that clients are invested in the right strategy for them, and that involves us every year or whenever clients tell us that their circumstances have changed, actually reviewing their strategy to make sure it's appropriate. So we charge a flat fee for that. And we think that's, a pretty good fee considering if you see a financial advisor, you're probably likely to pay thousands of dollars for, just an upfront consultation and then a similar fee on an annual basis. And then we also charge a management fee on the funds that clients invest, which varies from about 0.5% per year to about 0.8% per year. And then the only other cost that clients will pay, but they don't pay to us, is the actual cost of the ETFs themselves. So ETFs, like managed funds, have what's called like an embedded management fee. The beauty of ETFs, though, is the management fee is much lower than buying a managed fund, where there's a fund manager and a big team of analysts. Where on average you might pay probably 1 to 2% for a managed fund. ETFs on average would charge about a quarter of that, so about a quarter of 1%.
Yeah, great. So just to recap, and I've just crunched a few numbers just for the audience. So if you're under $50,000, if your balance is under $50,000, it's just the management fee. There is no advice fee. Is that right? That's just going off.
Yes, that's right.
Yeah. Mm-hmm. And as just an example, guys, if you've got a balance of $100,000 with Stockspot, their advice fee is $55. So you're going to pay that, per year, and their management fee is 0.055% per month. So it's not a lot, we're talking here. It actually works out to be on $100,000 is $55 a month. So then 55, that's 5 times. That's $660 a year. Does that sound right, Chris?
Yeah, it sounds about right. And I think the best point of comparison is probably, and where we compare ourselves to, is traditional managed fund platforms, which is I was talking before about some of the things I don't like about the industry. Managed fund platforms is a great example of a technology that's now outdated and very expensive, because if you're going to invest in a product on a managed fund platform these days, you'll pay a few layers of fees. You'll pay an advisor fee, which will be something like 1% a year. You'll pay a platform fee, which is probably another 0.5% a year. And then you'll pay a fund fee on top of that, which is usually about 1 to 1.5% a year. So the all-in cost of investing in a fund in Australia these days is about 3% a year, which is pretty ridiculous when you think that the average return you'll probably earn might only be, somewhere between 6 and 10% a year. So it's a huge percentage of your returns that the financial industry, exactly, that the financial industry is taking off you. And we actually did a study, which we repeat every year, which is called the Fat Cat Funds Report, where we actually try and analyze exactly what percentage of their returns people are paying away. And a couple of years ago when we did it, it was actually 45% of all returns that were made over a 5-year period were paid away in fees.
Unbelievable.
Yeah, exactly.
Now, a common question that gets asked in the forums, the Stockspot has been brought up on a few forums that I read now. A common question, and especially for my audience that might be a bit more financial savvy, I believe you can actually see which ETFs that you guys invest in each portfolio. Is that right when you do the sign up, or are they hidden?
Yeah, that's right. So again, like, one of our philosophies is to be very transparent with clients. And so they know exactly what they're getting and what they own. And so it show exactly what we're investing in for people. So
the question is, and it always comes up, if you can see what you guys are investing, what is stopping someone from just going to the source, Vanguard, for example, and investing in the ETFs themselves and avoiding the fee that you guys charge? What's the benefits of going through Stockspot for someone that might be thinking about that?
I mean, that's a great question, and it's one that our business gets, as well as our sort of similar businesses overseas. And I think an analogy to probably give you is it would be like saying, instead of getting a personal trainer, why wouldn't I just go onto YouTube and find a sort of personal training plan and do it myself? And I think a lot of people, would do that. The benefits of using a service like ours over doing it yourself is there's probably a few elements to it. First of all, if you just, let's say, use a Vanguard fund, the problem is that in order to work out which funds you want to use, you have to continually research the whole universe to kind of work out what is the right, the right funds to choose. And as part of our process is we're continually analysing the whole universe of ETFs to work out which are the best ones to use. Secondly, the advice side is quite important. So if you just statically buy some ETFs and leave them, the problem is that if your personal circumstances change and your strategy should actually be changing, you'll never know. And I think that's a trap a lot of people fall into is they'll buy an investment if they're managing it themselves and just leave it without really reviewing whether that strategy is still appropriate for them if their life circumstances change. So let's say you have a family or you decide that your time horizon is actually shorter because you want to buy a property. That will actually change the strategy that's right for you, but you probably won't know it if you're doing it yourself. And then I think that the last reason I would say, which is probably the most important, is that people that invest for themselves, as much as they have good intentions at the start, the problem is most people actually don't have the discipline to do it properly themselves, and they fall into a lot of traps, which mean that their actual returns will really undershoot what they could have earned if they just outsourced it to someone else. And to give you some examples, the traps that people often fall into is when the market falls, if people are managing their own money, they tend to panic and sell, thinking that the market's going to continue to fall, but that's usually not the right decision. And equally, when the market rises, that's often when people are chasing the market and buying more, when in reality that's probably not the best time to be buying. And so the benefit of an automated service is actually a lot of those human biases that everyone exhibits. Like even I know I exhibited it as a trader. We get to iron out and make sure that people aren't harming themselves. And there's been some great studies, actually. There was one in the US. I think it was run by a group called Dalbar, which looked at the average retail brokerage account. So, the average sort of equivalent of a CommSec or an E-Trade account in the US, and the returns that the average investor would get in those accounts versus an average, just an average index fund or just investing on an automated basis. And over, I think the study was 5 or 10 years, they found that on average, people underperform the market by about 7% a year. And a lot of that underperformance was due to the behavioural biases of overtrading, of chasing markets when they're going up, of panicking when the markets go down. So I think, automation is beautiful in that it can actually help people avoid biases that will harm their returns.
Totally. And does Stockspot charge a brokerage fee every time you want to buy?
No, so that's a separate benefit as well. Is if you're going to be a disciplined person and actually top up your account on a regular basis, especially if your balance is quite small, what you'll face is paying a brokerage fee every time you trade. That's a cost that we absorb and we include in just the management fee. So we don't charge clients extra if they want to top up, $1,000 a month, or if they just want to invest, one large amount at the start, we charge the same.
I think that's an important thing to note as well because, not only are you getting all the benefits that you mentioned, if you're making 10, 20 trades a year, that's going to add up. I know CommSec, I think, is around $20. So it's just one thing to be aware of if you sign up for this service, that you can buy in as many times as you want. I actually think there's you can B-pay, like you can set up a scheduled B-pay to do it just on autopilot if you want. So I think it's reasonably priced. For a balance of $100,000, you're looking at $715 by my calculations, including the 55 advice fee. Not bad. $715, unlimited trades with the advice fee is definitely a lot cheaper than any financial advisor I think you will ever find.
I think a separate sort of thing that people need to consider when they're investing for themselves is ETFs particularly, they're actually quite complex from a tax perspective. And so if you're trying to prepare your own tax or you have an accountant preparing your tax, it actually takes quite a long time to do all the calculations because you basically need to get a tax sheet from each of the ETFs that you've invested in, combine all of the different tax columns and then make sure that you've calculated your franking credits and all of those aspects correctly. Part of the technology we've built is actually automating that process. And so at the end of each tax year, we give everyone just a single statement that they can either give their accountant, which will take them, 5 minutes then to add into your tax return, or you can do it yourself.
That's an important thing to note because I know I own properties and it's come tax time. Yeah, it's a pain in the ass doing it all. So that's definitely a benefit.
Yeah, it's something, I'm sure with your properties, you have to then factor that into your returns, the money you have to pay your accountant every year in actually managing the properties you own.
Yeah, exactly. Chris, some of the other companies overseas that I see a lot, they have one of the features of investing in the company is tax loss harvesting. Is that something that Stockspot offer?
Well, first, I can probably explain very quickly to your listeners what tax loss harvesting is. What it basically is every day they basically look at everyone's portfolios and any ETF that they've invested in that has gone down, they actually sell and buy another ETF that's very similar. And what that does is crystallize losses that then you can use on your tax return to reduce your income. So it's a way of basically continually crystallizing losses and deferring gains, which is seen to be a tax efficient strategy. Unfortunately, or for better or for worse, in Australia, that's actually not allowed. The ATO very specifically prohibits making any sort of investment decision to optimize your tax in that way. And so, unfortunately, it's not a feature that we can offer.
Damn ATO. Another thing as well that some people might be a bit wary of, Stockspot sounds fantastic, but it's still a startup. What's going to happen with my hard-earned money if something were to happen to you guys and you guys go bust?
Yeah, another great question, and I think it's one that all people have when you're dealing with a new business, but especially one when it's managing your money. We've set up the business in a way that makes it as safe as possible for people, and the way that we've done that is when we invest for clients, they actually always own all of their cash and investments in their own name, on their own individual HIN, which is a holder identifier number at the registry, so basically at the ASX registry, which means that if anything ever happened to our business, it wouldn't actually affect the client's holdings at all, and clients would be free to move their holdings to another broker, and we basically have no ability to touch anyone's investments, apart from the rebalancing and the investing process that people allow us to do. So there's a few benefits of that. One is we actually allow people, if they do decide that they want to start to manage their investments themselves, we allow them to transfer their investments to a broker free of charge, and that helps them avoid necessarily realising capital gains or other tax implications. But it also means that that people can be confident that the money is always safely owned by them and that we can't ever touch it, regardless of whatever happens to our business.
That's fantastic. And you've actually answered my second question I had there, which was if for whatever reason you didn't want to use Stockspot anymore and you wanted to either do it yourself or go with another company, did you have to cash out and start again and get hit with capital gains or whatnot, or could you just transfer it to another name, which I think you've just answered?
Yeah, and I think it's a big problem with the industry as well, and something I never liked is if you buy a lot of these managed funds on platforms, not only are you basically stuck in them forever because you don't want to realize capital gain, even if their fees are high, but a lot of them actually have huge exit fees. Like a lot of the managed funds in Australia have like a 4% exit fee if you leave within 4 years.
Wow, I had no idea.
Yeah, that's something it really irked me because I think a good product should stand up on its own, and it's usually a sign of a bad product if you try and create friction to leave a product. So something I've always focused on is making sure our product has zero friction for people to leave, because I think that really gives people confidence to try it, because they know if they don't like it, they'll be able to leave, and it will be easy and cost free to do that.
Yeah, sure. Now, a lot of my audience will probably be in the retire early crowd, but let's say I don't want to retire early. I love my career. Why would I choose Stockspot over, let's say, super, which has, the tax benefit of investing in super? Is there a reason that I would choose Stockspot over super, or do you just want to talk a bit about that?
Yeah, sure. I mean, there's a lot of considerations for that. So I would suggest that, that's actually not a decision that we make. We only make the decision once people come to us and decide that they want to invest outside of super. But some of the things people would need to consider is, obviously, you mentioned the tax benefits of putting it into super. So you have to weigh up that side of things. And I would say you're weighing that up against the ability to actually use your money earlier if you don't invest in super. So obviously, if you put your money in super and you make a contribution to super above the 9.5%, then the benefit is you get a tax benefit, but the disadvantage is if you're 20 or 30 or 40, you're not going to be able to touch that money for decades, basically. So
and the government can change the rules whenever they want.
That's exactly right, as we've seen over the last year. Yeah. So the problem is that you might think it's great, you can get a big tax advantage, but if you wanted to buy a house in 10 years and you thought you might need that money for that, you're not going to be able to touch it to do that. So the benefit of not investing in super is that you do have more flexibility of when you use that money and what you use it for. But obviously, as you mentioned, the benefit of investing in super is that tax benefit. So it's just something people have to weigh up and decide which one's more important.
Yeah, good points. Do you want to talk a bit about Stockspot themes? I seen them on your website and they look interesting. Do you just want to walk us through those?
Yeah, sure. So what we found is actually a lot of the starter investors we have, especially people that aren't in the finance industry or aren't really paying too much attention, are very happy just to have a very well-balanced long-term portfolio. But then we have a different subset of clients who are a bit more experienced, probably maybe more like your listeners, who want to have a bit more involvement in the investment process. And we wanted to have a slightly different offering for that group of people because we realized they want to have a bit more say in how their money's invested. But at the same time, we didn't want those people to have so much say that they could, stuff up their investment strategy by taking too much risk. And so the way that we've balanced those two out is actually by allowing people to add what we call themes to their portfolio. And the basic concept is everyone gets the same basic core core portfolio, we call it, which includes 5 different ETFs, including Australian shares, global shares, bonds, gold and emerging markets. But then if people have a particular opinion about an asset class or an industry or a country they like, they can actually add it to their portfolio as a theme. So to give you an example, if you're sitting there and say, okay, look, I want a diversified portfolio, but I think technology stocks are going to go well over the next year and the US has more technology stocks, then you could add US shares as a theme to your portfolio. Or if you think Japanese stocks are going to go well over the next year, you could add Japanese shares. Or if you're worried about shares and you actually think you'd rather have a bit more in cash or in fixed interest, then that's possible too. So it's just a way for people to be able to tailor their portfolios a little more towards their views on the market, while at the same time we control the risk so people can be confident that they're not taking too much risk.
Cool. Great. Yeah, that sounds really interesting. And that's only for people with a balance over 50,000. That's only available to them. Is that right?
Yeah, that's right. So themes, because we actually don't add a huge percentage of your portfolio into the themes, just to make sure you're not taking too much risk. It really only makes sense if you're investing more than $50,000. Otherwise, it's just such a tiny dollar amount in the theme.
Sure.
But yeah, at this stage, we've only offered it for people that invest 50,000 and more. And we've had a pretty good take up, especially from people that do want to have a bit more active involvement. We also offer things like socially responsible shares. So people that, have a certain sort of philosophy around socially responsible shares are often choosing that as a theme to add into their portfolio.
Sure, cool. Can you invest under a trust in Stockspot?
Yes, you can. So the 4 different ways you can invest in Stockspot are as an individual, which is the majority of our customers. We also allow people to sign up as a joint account. So, yourself and usually yourself and a partner, or, someone that you're either married to or some sort of partner. We also have the ability for trusts to sign up. So we're usually seeing like family trusts and discretionary trusts. Usually because people have set up trusts for, tax reasons or other strategic reasons. And then the 4th way that people can invest is if they manage their own super, so a self-managed super funds. Okay,
cool. Just wrapping up, what's the ultimate goal for Stockspot? Where do you see Stockspot in 10 years?
Well, I think there's going to be a huge amount of change in wealth management and especially wealth management technology over the next 5 to 10 years. And so, the way that we're trying to position the business is to be the leader in that area in Australia and really to offer the best choice of investment strategies for people that are looking to get an investment portfolio. So I think our product will probably continue to evolve as we learn more from our clients and what they need. I think other areas of wealth management are also going to be interesting for us, like potentially in the future. We see a lot of our customers looking to buy a house with the money that they've saved up with us. So we'd love to be able to help them, access the best mortgage possible. And I think that area will probably change quite a lot over the next 5 years. So over a long period, I think we'll be looking at other areas of your personal finance where we can help people. But over the short term, we're really just focused on creating the best investment product.
Fantastic. Entrepreneurship, it's one of the fastest ways to reach financial independence. It's so impressive what you're doing with the company in such a short amount of time. If you could give one bit of advice to someone that's looking to go down that entrepreneurship path, what would it be?
I would probably say that entrepreneurship's rather than the fastest way to wealth, I would say it's probably the slowest and most grinding way to wealth. I think you probably hear people see on TV the very few fortunate people that manage to make a lot of money very quickly in entrepreneurship, but the reality is that they're the rare cases, and most people that have built businesses and all the ones I've met have before they've become well known or media faces, they've actually worked very hard in the background for many years. So I think for me, the type of person I think that would enjoy entrepreneurship is the sort of people that enjoy chaos, I guess, and not having a structure to their day. If you're the sort of person that likes to come in and have your list of things to do and then leave, entrepreneurship's probably not the right thing for you, because what we see in our business and it's probably similar to trading as well, is every day is different, and every day you have different challenges that are thrown up, and it's all about being able to respond to those different challenges. But that said, I love it. For me, that's the sort of job, I've always wanted to do, is something where you get to build something and then say, hey, look at this awesome thing that I've built, and it's helping people with a part of their lives. So for people that actually want to make a difference and bring something to the community and bring something to the world, bring a little baby to life, basically, then I think, entrepreneurship's a great way to do it.
Fantastic. And would you say, because you had a successful career before you had the startup, would that be something that you'd accredit to your success, to have a solid foundation before you make that leap into a business or a company?
I think from people I've met, other entrepreneurs, we work in a co-working space here in Sydney called Tankstream Labs, where there's about 70 different companies, and cool. I would say it's probably a commonality. A lot of the founders actually do originally have some sort of corporate experience, and I think corporate experience teaches you about the importance of structure, which is still important in a startup. So, it's not all just chaos. It's about setting up the right structure but also allowing enough flexibility to be creative and actually build cool stuff. So I think what corporate world taught me was, I think corporate world where I came from was way too focused on the structure, which really stopped creativity and stopped really cool products being built. And so what you learn is, where you think that line should be drawn or where that balance is about right. And with that actually having some sort of corporate background, I think people often in entrepreneurship lack the ability to set up the right frameworks and the right structures.
Great. It's an incredible company that you and your team are building, Chris. I just want to thank you so much for being on the show. Stockspot sounds like an amazing company, and if you're looking for hassle-free investing, be sure to check them out at www.stockspot.com.au. I'll put a link in the show notes. If you enjoyed this podcast and want me to make more, make sure you drop me a comment and rating on iTunes. It's hard for me to keep making these shows without knowing what you guys want to listen to, so make sure you provide that feedback so I can keep giving you what you want. Just search for Aussie Firebug on iTunes and you will find me. I'm also on SoundCloud at www.soundcloud.com/Aussie-Firebug. A transcript and show notes of this episode can be found on my website at www.aussiefirebug.com. Again, thanks for your time, Chris.
Thanks for having me on the show.
All right, see ya. Thanks, guys, for listening to another episode of the Aussie Firebug podcast. For links to all of the resources plus an entire transcript of this episode, head over to aussiefirebug.com. Make sure you never miss out on another episode by subscribing now on iTunes or SoundCloud.